Hello class. Before I get started going over problem 40 and 41 in chapter 8, I wanted to point out just a couple things in the chapter to you. I have typed them above as you can see on the screen. Okay, first in chapter 8 I want to point out to you that a consolidated return election must be filed if affiliated groups decide they want to file a consolidated tax return, if they meet the certain ownership tests. Now these are different than the ownership tests that you had to file as a consolidated group under financial accounting rules. Under financial accounting rules we looked at a 50% rule. Here as a general rule of thumb you're looking at an 80%. They also must file the proper forms. They have to adopt the parent's tax year, and most importantly are an eligible entity. I did want to take the time to point out to you that partnerships, exempt organizations, trusts, insurance companies, and foreign corporations are not eligible entities. Typically, your regular corporation is an eligible entity to file as part of a consolidated group. One of the companies I used to work for, we had an insurance company in our group, and they could not file consolidated with us, but all the other entities did together, and we had to file a separate tax return for the insurance company. So there are ineligible entities. Table 8.1 compares the effects in certain groups in filing consolidated versus separately, so you may want to pay attention to that, in particular where it talks about like intercompany dividends and other intercompany transactions, which I made a note to you to pay attention to those and to the rules in regards to NOLs. With that being said, let's go ahead and jump to problem 40. In problem 40, it said that basically the chief consolidated group reports the following results for the tax year. All right, they give you parent, sub 1, sub 2, and sub 3 and consolidated. What they're giving us is the ordinary income, the capital gain and loss, the 1231 gain and loss. They give us a separate taxable income. Then they also report the consolidated taxable income, the consolidated tax liability, an energy tax credit available from sum 1, and a net tax due. What the problem is asking you to do is to determine each member's share of the consolidated tax liability. All the members have consented to use the relative taxable income method, assume a 35% marginal tax rate. So we're going to do the relative taxable income method first, and then in problem 41 we're going to use the same information, and we're going to do the relative tax liability tax sharing method. So with the first one in problem 40, your emphasis is on the relative taxable income. So what you want to do is you want to set it up so that each of the entities, we've got parent, we've got sub 1, sub 2, sub 3, and sub 4. Okay. Alright, we just have parent, sub 1, sub 2, sub 3. There's no sub 4, so don't have to worry about that. Let's delete that one. And then our total. To go ahead and line this out a little bit. Alright, so the parents, we're going to put here, what is our separate taxable income? Okay, so separate tax income. Alright, for the parent, the separate taxable income, you can find this on page 839 in your book. Shows you is $850 for the parent, $200 for sub 1, $150 for sub 2, and a -90 for sub 3. Because we're looking at how we're going to share in the taxable tax liability, you want to put this in a 0. Now I know the problem says a -90, they had a $90 loss, but if they had a loss, they didn't add to the tax liability of the consolidated group. If anything, they took away from the tax liability of the group. So you don't want to ask them to share in some of that. So that's why we're going to put in a 0. Okay, so we're going to come down here. We're going to do an auto sum. We're going to sum that. And when we sum all these together, we come up with a taxable income of total of $1,200. Now we want to do our allocation rate. Okay. So we're going to allocate, and the way we're going to allocate is we're going to come over here and say 850 divided by 1200. So we're trying to figure out what portion is 850 to the 1200. We're going to say 200 divided by 1200. We're going to say 150 divided by the 1200, and then 0 divided by the 1200. And those are going to give us our rates based on taxable income and how we will allocate it out. Okay, now we want to look at what our tax is due. So if you look at the problem, let's look at what the tax is due. It tells us that our tax liability is $380. We have an energy tax credit of $70, giving us a net tax due of $310. So the $310 is what we're trying to allocate to the individual entities based on their relative share of taxable income. So what we're going to do is we're going to now take this allocation rate, and we're going to multiply it times parent's separate taxable income. We're going to take the allocation rate for sub 1 and multiply it times their, not taxable income. We're going to multiply this allocation rate, times the tax due. And we're going to come down here and multiply this allocation rate times the tax due. Almost got off on line there for you. And sub 3, we're going to do the allocation rate times the tax due. And for 4, we're going to do the allocation rate times the tax due. Right? When we do that, we will see that this parent is going to pay $219.58. Sub 1 will owe 51 of the tax liability, 38 for sub 2. You want to total it up one more time to make sure that your total, so we're going to go here and hit auto sum, total it up, and it's 310. So what we've done in problem 40, make a note that this is problem 40. Insert a line here, and make this one problem 40. Is we have allocated that $310 right here of tax due, this 310. What we've done is we've gone over here in total and we've allocated based on taxable income. Now what problem 41 wants us to do is it wants us to use the same information. So I'm going to kind of use some of this. It won't all be identical, but let's go ahead and copy this down. And it wants us to allocate this now based on, it said, the relative tax liability sharing method. So we're still going to start off with a separate taxable income of $1,200, just like we did above. And delete that because this is going to be a little different. Alright, and we're still going to be allocating $310 in taxes due. What we have to do here, though, is we have to first compute what the tax liability would be for the individually, separately reported entities. So we're going to take this $850 and we're going to multiply that times the tax rate, which it said was assume a 35% marginal tax rate. We're going to do the 200 times the 0.35, the 150 times the 0.35, and the 0 times the 0.35, which we know will be 0. Let's sum those together. Okay, and that gives us $420 based on allocations. Okay, but I've got a tax credit. Looking at the problem, you'll see that I have a tax credit of $70, an energy tax credit for sub 1. So let's put a column here for tax credit. And what we're going to do with our tax credit here, we're going to put that sub 1 tax credit that they have for $70. Here again, I'm going to do away with that total, or we can just leave that total because that'll be the total of any tax credits that we have. $70. So now our allocated after the tax credit is going to be the allocated amount of tax liability minus any credit. So if we copy that down, and then we sum of this, now we see we're at $350 is what we have according to our allocated amounts that we're showing. Okay? But now we've got to actually look at what our tax due is going to be. Okay? So to do it, we're going to come up with an allocation rate now, but our allocation this time is going to be based on the relative tax liability. Okay? So we're going to take the 297.5 here, divided by the total of 350. So this is kind of like what we did above. 0 divided by the total of 350. We're going to take the 52.5 divided by the total of 350 and the 0 divided by the total of 350. Come down here, let's sum that up. And it should give us a 100% allocation rate. Don't need to really do that. I was just wanting to check it, but that's okay if you want to leave that total there. Then what we're going to come up with is what our allocated tax due. Now this allocated tax due will be done just kind of like what we did up here in problem 40, where we're looking at the 310. So now we're going to take this allocated ratio, we're going to multiply it times 310, which is the actual amount of tax that is due. So we're going to do that for this. First, for step 1, divided by the total tax due. For step 2, divided by the total tax due, and the allocation rate times this one. I didn't do times, so we're going to do that times tax due. Okay. Alright, so when we do that, let's sum this up again. And we see now the allocated tax due is $310, just like what we found there. Okay. So let me go ahead and I'm going to unshade this one. Okay. So in problem 41, the difference is we had to compute our tax liability, which we did here. Then we applied any tax credit. We got the liability after the tax credit. Then we said what was each of the companies to this total of 350. Got a new allocation rate. Applied that back over here to the 310. If you use the relative taxable income method like in problem 40, then all you have to do is take each of them individually here to the total taxable income, set up an allocation rate like we did here, and multiply it times the 310. So problem 40 is actually easier, but both are acceptable methods. I hope that helps as you go through the material in chapter 8.